in the 21st century. Hard-working people working hard for you and me. Moving higher, time and time again. Through the years you'll find us here. Moving higher.
Hello and welcome to Moving Iron Podcast, Tax Moves with Glen Birnbaum. Glen is with Heinel Banhort out of East Peoria, Illinois, and this edition of the Moving Iron Podcast is brought to you by Dawson Tire and Wheel, your premier ag tire and wheel provider in North America, helping people grow. Glen, it's been a little bit, man. How you been?
Good, Casey. Yeah, it's hard to believe January's over, but we'll take it. So we didn't have too bad of weather here in Illinois. So
yeah, no, we've had some actually unseasonably warm weather here in January compared to what we had leading up to January. So all things said, I can't really complain much about what's going on. Now this morning we've got 25 degrees and snow. It's amazing how the weather can swing from 63 degrees on Sunday, and then here it is Tuesday, and it's 25 degrees, or actually it's 14 degrees and 4 inches of snow. It just never ceases to amaze me when it does that.
For sure.
Yeah. All right. So you wanted to talk a little bit today about QBI or qualified business income and the DPAD as far as what happens with co-ops and how they can use different funds for different things. So I guess Glen, take it off there because that's about my level of knowledge on the subject.
Yeah, you've introduced it well. Yeah, I think we're about 23 months in and we're still talking about the co-op and the DPAD and all this stuff. So one thing, January 31st would have been the deadline. It's the deadline to get your W-2. If you hopefully, Casey, you've got your W-2. Mm-hmm. It's also, you should be getting your 1099 PATR, or basically the patronage form that you get from your co-op if you're selling grain to a co-op. So now some boxes are kind of front and center on there. And so I want to talk about that a little bit, and then we'll get into the QBI. So what we're talking about is box 6. And box 6 is still labeled DPAD for 2019. And that's the co-op has the option whether they kind of compute their own kind of calculation, and they can either choose to keep all the deduction for themselves or they can elect to pass it out to the farmer. And so you might either find something in box 6 or you might find nothing in box 6. The other new box for 2019 on this form is box 7, which is basically called like qualified payments. And we've seen here in Illinois several co-ops where that box is blank, and I've talked to some other tax preparers. And if you do see that box is blank, it may be that the co-op perhaps did not realize, that that's a new form and you have to fill it out. So there is some confusion about how all this works. So we have a new box 7. It may be blank. If it is, you probably want to follow up with your co-op. And we have box 6, which I've seen has been blank as well on some co-ops around here. And again, that's the DPAD deduction. So what if box 6 isn't blank, to get to your kind of what you introduced there? How do we compute our qualified business income? Okay, so typically what we're going to look at, if we're going to look at our Schedule F income, and we are going to have to factor in certain other deductions like self-employed health insurance or self-employment tax. But the bottom line is kind of our net farm income, right? We get this 20% deduction initially. That's kind of what we're hoping for. And if we sell to a co-op, it's a more complicated calculation. If you remember, Casey, we called it the deduction or reduction, where possibly your 20% deduction might go down to like 11%. And there's complications with that. But if you're a farmer and you don't pay much wages or zero wages, then you really aren't going to get much of a hit. You're going to be able to still keep your 20% deduction. So the question that's come up here in the last 2 or 3 months, which is still, I thought that we'd get some clarity on this in the month of January. We did not. So I've kind of been holding on it. We did talk a little bit about it in December, but the question is, do I have to take that DPAD deduction that comes from on that form? And remember, I didn't pay any cash for this. It's not like I wrote a check. This is just like a deduction that the co-op didn't use, and they said, here, you take it. And so do I have to take that deduction and reduce my qualified business income or my farm income, which obviously hurts me a little bit, right? If I have the less income I have. So, in a simple illustration, right? If I make, $100,000 on my farm, with all my deductions factored in, and then I get a $20,000 pass-through deduction from my co-op, right? Do I get a 20% on $100,000, which would be a $20,000 deduction, or is it only 20% on $80,000 because I've got to factor in DPAD? And right now, we don't know the answer. The IRS has kind of informally said that you should subtract this. It would be news to most tax preparers that I know. So anyway, it's just one of those things that we still don't know exactly how to compute it. So anyway, take a look at your 1099 PATR. If box 6 is 0, then really this isn't an issue this year, but it could be an issue going forward from that perspective.
I guess, so what's your advice then, Glenn? I mean, it sounds like to me, even if the box is 0, you still have a risk of not being correct. So what's some advice you would have for folks out there to maybe forego some hardship here?
Well, yeah, I mean, if box 6 is 0, and I was talking about it as well, but, if we're talking about box 6, the DPAD, if it's 0, I mean, I'm pretty sure that's correct, meaning that they didn't pass any deduction out to you, so then you don't have to worry about it this year. Box 7 is kind of another matter. It's more of a technicality for the co-op that they, it's just a new form and they don't understand how to deal with it. But if you do have something in box 6, obviously we're giving just general guidance here. Always consult your tax advisor. But there's nothing formal by the IRS that says we need to reduce QBI by the DPAD. From my perspective, I'm going to talk about it with my clients and make sure they understand the risk. But until we get, more clarity, I haven't filed any returns yet, but I'm not sure I'm going to follow that informal rule until we get more guidance. When we look at the statute, the actual Internal Revenue Code, we don't see that should be a deduction. So,
yeah. Well, I'll tell you what, man, you think they'd have this figured out by now, because you and I first met because of this whole issue.
Yes.
And here we are. Just the content that we've been able to lay down because of that's been great. But, my God, you'd think they'd have some level of clarity here now, almost 2 years into this.
Yep. So another thing I wanted to talk about, again, kind of another not very clear, and this would be, what if you have negative farm income, right? Or negative QBI. This is, this can happen, right? Certainly times are tough, or you may take depreciation or things, right? And create a loss. And, so anyway, how do you handle this when you have a loss? Okay. So this would be the situation where you're a farmer and you sell all your grain to a co-op. Okay. So we have to put our math hat on here, Casey.
Right on.
So this will be interesting. So if I don't have any wages and I sell all my grain to a co-op, okay? When you have positive income, you take the lesser of, let's say I made $100,000. So again, we'll get to this negative example. If I made $100,000, because I got to keep the math simple, I possibly could get reduced by 9% of $100,000 or $9,000.
Right.
Deduction or reduction. But if my wages are 0, the lesser of 9% of 100,000 or 50% of my wages. And obviously 50% of 0 wages is 0. That is less than 9,000. So my deduction or reduction is 0. Okay. That's why if you're a farmer, you don't have much wages, you really don't have to worry about this. Okay.
Okay.
All right. So let's flip it. What if we have a $100,000 loss? Okay. And you do the math and the form is finalized. We did not have forms last year. We had worksheets. Now we have a form. It's finalized. And if you work through the math, 9% of negative 100,000 is negative 9,000, right?
Right.
And is negative 9,000, this is your math question, Casey.
Okay.
Is negative 9,000 less than zero. In other words, 50% of wages is zero. It's negative 9,000 less than zero.
It was when I went to school, yes.
Yep. So
it's
less.
They have a whole new way of teaching math now, so I don't know for sure what they got going on.
Okay, so now your deduction reduction is negative 9,000. You follow me?
Yep, I'm tracking.
And so if you work through the form, it says you subtract negative 9,000. It basically indicates that you would actually increase your deduction by 9,000. So your 1,998 deduction would go from zero to $9,000, right?
Okay.
Now, this is what the form says. You would think they would have said if less than zero, make it zero. They have these things. So people are wondering, like, is this just a typo? But this forms went through 2 or 3 revisions. And so potentially, you could carry this on and say that if you have negative farm income, you actually get a free 9,000, in my example, 9% deduction. Now, how this would factor in next year or something, but we don't know if this is really going to hold water. But literally, according to the form, if you just follow it through, it might work out. So
let me get this straight. You're saying there's a glitch on the form that's going to give you an additional reduction in your tax liability if you have a loss. Correct.
Now, if you really think it through, though, if that's the only income you have on your return, this negative 100,000, you may remember this. There's an overall limit to this deduction of 20% of your taxable income. So in my scenario, if you had this negative 100,000 on your Schedule F, you'd have to have some other income, spouse working or some other businesses that would be able to use that extra $9,000 deduction. But it just kind of shows, that again, 2 years in, we're still kind of working through some of these little quirks about, going back to math, like you said, and what's the lesser of. But the form is very clear that, you can't have a negative number. So anyway, that's more of just a tidbit. Hopefully, listeners aren't in that situation where you've got negative, but you could have a negative Schedule F, but then you have another business, right, that's making money. And because you bought a fair amount of equipment, right, maybe even some equipment, on your farm, you have a loss in there and you want to offset that against your other income. So it's just extra complications.
Sounds like it.
And this has probably been known for, 4 or 5 months. So just not clear guidance. So we have the final form, but the instructions for that final form have not been finalized yet. And so I was really hoping we'd get the final instructions released in January so that I could talk about more of this, but so we'll see how that comes into play.
Man, it's you would think that they would have. I don't know how it goes through so many revisions, and then there's still all these questions in the air. So I don't know. Good stuff, government for you, I guess, right?
Yeah. Other things, Casey, just that we did. Well, January 15th was the fourth quarter estimate, and so some farmers do make a fourth quarter estimate. Other farmers have until March 1st, so you don't have to make any quarterly estimates if you file your tax return and pay your tax by March 1st. And so that deadline is approaching. Will we have final forms? Will we have, it may be that we may not be able to file quite on time. In years past, sometimes the IRS has extended that and said, hey, I think they did it like in the last 24 hours last year, that, now we'll give you till April 15th. So we're looking at that. But yeah, people are, dropping off their information. One thing we're looking at, as you know, is, obviously government subsidies are up. And so some clients of mine are looking at making sure they're going to there's certain limits, right? Income limits to be eligible for farm income, the subsidy payments, right? And so a lot of times those are based on like a 3-year average, and you go back several years. And so sometimes we're just evaluating, do we want to show a certain income number just to kind of keep our income below a certain threshold, right? So we can be eligible for farm program payments in the next year. several years ago when I talked to my clients about this, most of them were not concerned about government payments, right? I don't know, and now obviously things switch, maybe just like the weather, like you said earlier, things can change on a dime. And now, we're trying to make sure we're taking a real big picture view. So I may say, hey, I'd like to show some income here from my perspective, because we're going to use up a certain tax bracket. We're not really paying that much tax. We want to take advantage of these low brackets, but it may be that throws us over a threshold looking back 2 or 3 years. If we had some particularly high years or higher years in the past, right, we might need a lower year to take our 3-year average down. So a lot of things to think about. And so one of the big choices in doing that, you might say, well, how can you adjust your income after the fact? Well, one of the big things would be depreciation, right? If I take a lot of depreciation, I can get a loss or get my income down lower. And if I take just kind of regular depreciation, my income would be a lot higher. So that's still a lever we can pull, talking to people in February about things. So just be aware of that as well. It's not just income tax law. It's, we're trying to really think about everything. And then obviously we don't know what prices are going to be, but the prospects are, I guess it was just announced we're going to get the third tranche of MFP payments, right?
Yeah, I saw that. Yep.
So anyway, it's just another thing we have to look at is maybe we should keep our income down, or at least 1 year should be down in order to keep that average where we want it to be. So.
Well, good stuff as usual, Glenn, man. You got a ton of stuff going on there and a lot of stuff going on as far as just keeping all the balls up in the air without dropping anything. So, as usual, make sure you talk to your tax professional about this stuff. And if they want to talk to you about this stuff, Glenn, what's the best way to do that?
Yeah, it's best to call my office here in Heinold Banwart. 309-694-4251 is the number. Or you can always look me up on Twitter at Glen Birnbaum is my handle.
Yep, Glenn does a really good job about getting stuff out there on Twitter, and then the feedback that comes back from the other tax professionals that are out there on hashtag tax Twitter is always good. So
a good resource. Yeah.
Good resource for sure. So Glenn, it's always a pleasure talking to you, man. Anything else you want to throw out there before we shut this thing down?
Nope, I think that's enough.
Okay. Well, I am Casey Seymour with Moving Iron Podcast. Make sure to check my podcast out on anywhere you can find a podcast, iTunes, Google Play, any of those. Also check out globalagnetwork.com for all the latest news of the other great podcasters that are out there on the network. And also check me out on Facebook, Twitter, Instagram at Moving Iron LLC. And I guess till then, I'm Casey Seymour for Glen Birnbaum. Let's go move some iron, folks. Out.
Moving higher in the 21st century. Hard-working people working hard for you and me. Moving higher, time and time again. Through the years you'll find us here. Moving higher.